If everyone paid off their debt tomorrow, the economy would collapse. Every bank would fail. Every business would close. Money itself would vanish. This isn't a warning. It's how the system was built. Here's what nobody tells you. Money isn't printed and distributed. It's loaned into existence, which means every dollar you've ever touched is someone's debt, including yours. And the moment people stop borrowing, the whole thing stops working. That's not a flaw. That's the design. You were taught money comes from the government, that the Treasury prints it, mints it, controls how much exists. And sure, physical cash gets printed, but cash is 8% of the money supply. The rest exists because someone signed a contract promising to pay it back. Your mortgage created money. Your car loan created money. Every credit card swipe creates money that wasn't there a second before. Not transferred, not withdrawn from some vault. Created out of nothing but a promise and a signature. Here's the part schools don't teach. You walk into a bank. You ask for $100,000. They check your credit. They approve the loan. And then they type the number into your account. That's it. No vault. No transfer. They type and $100,000 appears. You might be thinking banks lend out deposits, that savers put money in, and banks pass it along. It feels logical. It's also backwards. You didn't borrow money that was sitting there waiting. The bank didn't lend you someone else's savings. They created your debt and your spending power at the same moment. Both sides of the transaction just materialized. Before you walked in, that money didn't exist anywhere. After you sign, it does. This is called fractional reserve banking. But that name hides what's actually happening. Banks create money by creating debt. Banks make loans first. Those loans become deposits second. When you take that $100,000 and buy a house, the seller deposits your payment into their account. That deposit didn't fund your loan. Your loan created that deposit. The system runs in reverse. Money is loaned into existence, and then it circulates. The Federal Reserve doesn't control this directly. They set interest rates. They set reserve requirements. But the actual creation of money happens at thousands of individual banks based on one thing: whether people want to borrow and whether they qualify, which means the money supply isn't managed by some central authority deciding how much the economy needs. It's managed by loan officers deciding whether you can afford the payments. Every time they say yes, new money enters circulation. Every time someone pays off a loan, money disappears. You might be thinking, debt isn't the same as money. That difference matters more than it sounds. If money is created when people borrow, then the total amount of money in the economy is the total amount of debt, not related to debt, not backed by debt. Debt is the money. More borrowing equals more money. Less borrowing equals less money. That means economic growth doesn't just need spending. It needs debt to grow, not stay level. Grow. If people started paying off loans faster than they took out new ones, the money supply would shrink. And a shrinking money supply means deflation, bankruptcies, mass unemployment. The system doesn't just encourage borrowing. It requires it. Without new debt, the economy doesn't slow down. It suffocates. Think about that. Your paycheck exists because someone borrowed. The price of groceries exists because someone borrowed. Your savings account balance exists because someone, somewhere, promised to pay back more than that amount. Every dollar in circulation traces back to a loan. You might be thinking, okay, but where's the catch? This is it. Let's say the only money in existence is one loan. $100 at 10% interest. After a year, the borrower owes $110. But only $100 exists in the entire system. Where does the extra 10 come from? It can only come from another loan. Someone else has to borrow new money into existence to cover the interest on the first loan, which means they now owe interest, which requires another loan, and another. The system doesn't work unless borrowing never stops. This is why central banks panic when credit freezes, not because debt is bad, but because in this system, debt is the oxygen. When people stop borrowing, the math problem reappears. There's not enough money in circulation to cover all the debts plus interest. Someone has to default, and defaults destroy money faster than loans can create it. The economy doesn't collapse because people are irresponsible. It collapses because the math was impossible from the beginning. Now, banks will tell you this is fine because loans get repaid and the money gets destroyed. When you pay back your mortgage, the balance disappears from both sides of the ledger. Money in, money out, clean. But here's what they don't mention. The interest doesn't disappear. The interest stays with the bank. That becomes profit. That gets paid to shareholders, executives, employees. So the principal vanishes, but the rent on that money stays in circulation. You might be thinking, this sounds like a scam. It's not. It's a business model, and it's working exactly as designed. Banks are extracting wealth without producing anything. They're not building houses. They're not growing food. They're typing numbers into accounts, charging rent on those numbers, and deleting the original numbers while keeping the rent. At this point, you might be asking the obvious question, why not skip banks entirely? So, why don't governments just create money directly? Why go through banks at all? Why not print debt-free currency and spend it into circulation? Some countries have tried. In theory, you could fund roads, hospitals, schools without anyone owing anything back. But most governments don't do this. They borrow instead. They issue bonds. Banks buy the bonds. The government gets money now and promises to pay it back later with interest. The reason is control. If governments could print unlimited money without borrowing, the temptation to overspend would be extreme. Inflation would spiral. Weimar Germany, Zimbabwe, Venezuela. History is full of examples. So the bond market acts as a leash. If investors think the government is borrowing too much, they demand higher interest. If rates spike, the government has to cut spending. The other reason is power. The financial system doesn't just create money. It decides who gets it, who qualifies, who gets locked out. That's not a technical detail. That's control over the entire economy. And the people running that system benefit from keeping it exactly as it is. Here's the uncomfortable part. Most people never learn this. It's not taught in high school. It barely comes up in college, unless you major in economics. Politicians talk about deficits and national debt, but they never explain that government deficits are how new money enters the economy outside of bank loans. When the government runs a deficit, it's adding money to the private sector. When it runs a surplus, it's draining money out. That's the plumbing. But the conversation is framed like household budgets, which brings us back to the fact nobody wants to say out loud. The money system isn't neutral. It's not just a convenient tool for trade. It's a machine that requires constant growth, constant borrowing, constant debt to function. You didn't opt into this. You inherited it. Your mortgage isn't just a personal financial decision. It's a structural necessity. Your student loans aren't just your burden. They're part of the fuel the system runs on. Every month you make payments, you're not just paying back what you borrowed. You're keeping the entire apparatus alive. None of this is hidden. The Bank of England published a paper in 2014 called Money Creation in the Modern Economy that explains all of this in plain language. Central banks don't deny how it works. The information is public. It's just not publicized. Because if people understood that money is debt and debt requires interest, and interest requires more debt, they might start asking better questions. Not how do I get out of debt, but why is the system designed so I can never get out? Some economists will tell you the system is efficient, that it allocates resources to their most productive uses, that it allows economies to grow faster than they ever could when money was tied to gold or silver, that it rewards innovation and punishes waste. Other economists will tell you it's a trap, that it creates cycles of boom and collapse, that it concentrates wealth with those closest to the money spigot, that it turns entire generations into permanent debtors by design. Both are right. So the next time you hold $1, don't ask where it was printed. Ask which loan created it, who borrowed it into existence, who's paying interest on it right now. Because that dollar isn't value. It's a fragment of someone's promise to pay back more. And the system only survives if that debt keeps growing forever. Which leaves one question nobody wants to answer. What happens when people stop believing?